JP, how are you, my friend?
Good morning, Lewis. How are you today?
I'm doing really good. I'm excited about us actually having a conversation because we haven't talked for a few days. And we're going to be talking about whether or not people have a bucket list and how do you fund a bucket list. And the concept came into existence because I was talking to a client and several clients in the last week, and there was this whole discussion about I want to do this, I want to do that with my retirement. But the big one is really retirement. There's usually a few small ones, but the whole concept of a bucket list, I want to move to Florida, I want to buy this second home and all that, or I want to travel. It got me thinking because many times our job is in the planning arena is to figure out how we're going to fund them. And I wanted to ask you, um, what is the difference in your mind between, when you're accumulating money and you're putting money away and you're building it up versus when you're actually pulling it out? When you're funding that bucket list, you're actually spending that money. What is the biggest difference from your perspective, from accumulating versus taking it out, distribution?
It's a good question, and I think I've seen the same type of problem working with clients. So when you have a specific goal, I think there's a question of timing, right? Usually, it is a single lump sum disbursement of money, right? For example, let's say you want to buy yourself right now this big this big RV, right? To go, said I'm not traveling on the plane anymore. I want to buy myself that giant RV, and it's going to cost a lot of money, and it's oftentimes has a specific timing, which is oftentimes sooner rather than later. When you talk about retirement, your retirement money has to last you for 25, 30 years. And that is the kind of planning we do around this. If you say, I want to buy myself this big RV within 5 years of retirement, that is a very different time frame and a very different way of viewing that disbursement. And at that time, you're going to have to write a check for $100,000 for that big, beautiful RV, right? So there's a question of timing. And then we can talk about funding options. I mean, I did some simulation on that, and I think we can look at the impact of various ways of looking at it.
Yeah. Yeah, that's true. The time is a big part of it. Like how long is it? Because that has a lot to do with how long till your goal. That has a lot to do with how you're going to fund it. I was thinking about, I don't know if you remember back in 2008, I wrote that white paper called Investing for Sustainable Income. I don't know if you remember that. That was
Yep,
quite a
yep,
while ago.
definitely.
As I was getting ready for this call, I pulled that up because I wanted to kind of review it again because, it really has a lot to do with what we're talking about. I hadn't really thought about it prior, but and when I was going through it, it really reminded me of all these big issues that you have to deal with. The time is one of them, and I was thinking about the big one. The big goal is usually that retirement income stream. That's usually the big one. But when you look at it, there's like a few real big headwinds that you have. When you're accumulating money, you have the dollar cost averaging effect where you can buy more shares of whatever you're buying when the market's down, and then you buy less when the market's up. But when you start pulling money out, you have the reverse dollar cost effect where you're selling out more shares when the market's down, and so it's harder to recover from that. And this is one of the things that I think a lot of people get wrong. They figure that, well, if I have a return of say 5% in my portfolio on average, then I should just be able to take out 5% or 10%. Usually the number of people think, well, I'm going to average 10%, so I'll take out 10% from my portfolio. But you really can't do that because of a lot of different things. You have volatility, and then you have inflation, and you have taxes. Those are the three big ones. And as I was going through this white paper, it reminded me of that with funding the goal because that seems to be the biggest disconnect, I think, when people are thinking about funding their goals.
Yeah, and I think there's something that we all fall victim, and sometimes it's useful, is the idea of mental accounting, right? So if you think about little buckets of money, this is retirement money, and this is for my RV, and this is for travel, and this is for education, right? And it makes sense to think about this way, even when we think about professionally managing those assets, because of what I just mentioned. Sometimes the time frames, or when that cash flow comes necessary, is important to manage forward. The amount of risk we're willing to take to get there because of volatility. If you know you're going to need that money for college in X amount of years, of course, if that happens if you have a very risky portfolio and you're in a very big drawdown, that is going to be to be costly, a costly decision, right? So I think it's appropriate to think in a bit of a mental or compartmentalized view of your goals, not as one big pot of money. Sometimes it's fine, but other times we have to look at it in a more specific way and say, okay, how do we get from here to here for this specific goal, and all the other ones side by side. So, and I think playing scenarios, and I think this is what's interesting about having these calls, and people might be looking for, okay, what is the recipe, right? And I think there is no recipe to get there, because you change one little parameter based on somebody's situation, whether it's, you mentioned taxes, or asset location, is it tax deferred, taxable type of money, all have an effect on what is the right or optimal way of funding a specific goal.
Yeah, that's huge. So we talked about the volatility and the inflation and the taxes. The first thing is that, along the lines of what you're saying, is that you're probably going to need to be pulling more out later because of inflation. And you're probably going to need to be pulling more out if you have a tax issue, right? Because if you have taxes, then you're going to have to pay that tax, and then that, whatever's net left over. And then plus, if volatility is in the portfolio, if it's not a guaranteed investment with a zero standard deviation, then inevitably, because of the reverse compounding mathematics, when the market's down, you have to have a bigger percent up to break even. So you have to overcome the withdrawal rate plus inflation plus taxes plus. So it actually adds up to be a pretty big number. That's why the sustainable withdrawal rate is a lower number. But getting back to what you're saying with kind of there's no formula. I think one of the things you mentioned was asset location. And I got into this whole mindset of tax diversification. It's this new concept, because one of the problems we have, I just did a plan for a gentleman, one of our clients, great client, but most of his money, he has very little flexibility in tax planning. Going to retire in a few years. So he's got no tax diversification. So if you have different account types, the Roth, the individual account, and then maybe you have some 401k, you have tax deferred, tax free, and just taxable accounts. Maybe you have insurance or real estate. You have flexibility on how you're going to be, what sources you're going to use. And a lot of people today do not have enough tax diversification for contingencies. That's probably the largest problem we run up against. Because everybody thinks I'm just going to plow all my money in my 401k, and then you have a problem if tax rates go up. You have that's very, very common, because that money, you have to withdraw a lot more money. In fact, in this, I was just thinking about that. You brought it up. I was just thinking about it. There's this one page that I had in here that was talking about the estimate of the how much difference you would have to pull out. I isolated a tax deferred account versus a tax free and then depending on your turnover rate, and your asset allocation, it affects how much you need to take out. So it's a big problem. So talk to me a little bit about, when we talk about volatility and when you have markets that are down, you and I have talked before about this concept of a buffer allocation. You might remember that. So where you have some money set aside for, when you have the market down, you don't have to pull out of the market. You have other money that can buffer you, say 1 to 3 years. I mean, talk to me a little bit about how you would think about the amount that you would need to buffer. And let's just talk about it from a retirement standpoint. And we can move to other single goals too, but I'm just kind of thinking about retirement right now. because I think that's people's biggest thing. How would you think about buffering a portfolio from a standpoint of having money set aside from the market?
Yeah, you have to look at it in a way that gives you flexibility. I think that's the right word to do it, where you have flexibility of when to take the money. You're not forced to sell at the wrong time, right? So depending on how you feel about investments, we do feel that we're okay carrying cash when it's appropriate, when we see, for example, risk in the market, right? So if we see higher volatility in the market, we might be okay carrying more cash into the accounts. That's an asset allocation decision for us as the manager, but it also comes at a time when you might be needing that liquidity, and you don't want to be forced to sell again at the wrong time when you have when the market is down and you're in a drawdown. So I think it is dynamic over time. Again, and it's not a formula. Say, okay, you should have always 5% or X percent. I would say in general, I mean, we like to keep at least maybe 6 months of withdrawals in the account, so we don't have to worry about it for a while. But sometimes it might change, right? So. But what's important is, for example, I mean, I was looking at a single goal. Let's say, to go back to my RV example, right? If you were to take an entire amount, let's say that RV cost you $100,000 and you take it all this year. So I need that RV right now, and you take it all. The impact to your financial plan, let's say you're a 50-year-old, like myself, and said, okay, I need that money right now. The impact was about 3 years on your retirement life expectancy. Let's say a typical, of course, everything would change, but it had a 3-year impact to my retirement plan. For example, the fact that I'm taking it all into one lump sum right now, because that money is no longer growing and working for me, right? If I had the ability to spread that amount over time, let's say I take a loan against it and pay it over 10 years, that minimized the impact to about 1 year, right? So the negative impact of that.
Sometimes debt is good.
Yeah, sometimes 10, exactly. Sometimes 10 is good. So those are the kind of moving parts that we have to look at, right? So what is the appropriate amount to take from that standpoint? But go back to your point. I mean, what is the right amount of allocation? We believe you have to maintain growth, right? It doesn't mean that we're moving to cash or we're moving to bonds. We all have to insulate ourselves from inflation and from and protect ourselves against increase in cost of living and taxes. So we have to maintain that, yet providing the amount of liquidity that is required from that portfolio that is sustainable and maximizes the longevity of that portfolio, right? So
yeah, that's really interesting. Excuse me. Yeah, you were talking about the 6 months. I was thinking, okay, so we have a cash reserve kind of a situation where you just, when you're working, you need a cash reserve between 3 and 6 months, maybe even a year, depending on how many people are working, spouse and not spouse. That's one thing. But then let's say I'm retired now, and I have a total return portfolio. So basically what you were saying is we want to work from a total return standpoint, which just means we're going to look at all sources of returns: interest, dividends, short-term capital gains, long-term capital gains. Mm-hmm. And that if you have a long-term goal, it's usually better to do that to overcome inflation, because I was looking at the bonds, only 40% of the time do bonds outperform inflation on a nominal basis. After taxes, it's like almost zero. Mm-hmm. So you can't just own bonds, and you're going to definitely you're not going to pull ahead of inflation and taxes for sure if you have a bond portfolio. So we have to think about capital gains and all that. But that means we have more volatility when we do that, unless we have a guaranteed investment. But let's just stay with the stock and bond part of it. So if we have more volatility, then since we have this dollar cost average, reverse dollar cost average problem, that makes us have to pull more money out, one thing that we can look at is the buffer allocation. And I did a bunch of simulations in this paper, talking about that. And what I found was 1 to 3 years. 1 to 3 years buffer is good. And then the rest can be total return or even more high growth, because usually your drawdowns are done between 1 and 3 years. And then, so there's a concept of you can go to extremes. You have asset liability, perfect cash matching, which is you're going to have riskless assets that are matched exactly to the duration that's going to go to the liability, if you could do that, if you could forecast it. That's one extreme, like the most conservative extreme. And some insurance companies use that. It's not the optimal way to go, because you're going to have the least rate of return. But if you wanted to be the most conservative, that's what you would do.
It's a sleep at night factor for sure to that.
And then on the other end of the extreme, you'd have all stock, and you can't really do that either for most goals. So there's an art to this, and it requires you need to know all the parts. Tax diversification, right? I mean, it's not as easy as people think. I mean, it's funny how you get these questions. Oh, how much? The typical question is this: how much can I pull out of my portfolio of just dividends and interest so I don't touch the principal?
Yeah. No,
right? I mean, have you heard that? How many times have we heard that?
Well, I know exactly. And sometimes people have a concept that, or a preconceived idea of what that withdrawal rate, that percentage is. And sometimes we have to reset those expectations on, in a regular, in the world, what is the, that we live. I mean, what is your expectations of equity returns in this environment right now, right? I mean, if you tell me 12, I may have a problem with that. If you say maybe I expect 6-7%, then I'm more reasonable. So that right there is going to be an adjustment of expectations and what is possible to do with a portfolio, a diversified portfolio of equity and bonds. So I mean, I think you're right. I think the first thing, you've talked at length about the planning process, right? But first is to identify those goals and quantify those goals, right? So quantify, and by quantifying, we need to know, well, what is the dollar amount, as well as factoring inflation, but also the timing of it, right? So when is that necessary, right? Whether it's a lump sum or whether it's it's more of an annuity or an income.
And how knowable the dollar amount is. Like you could estimate the dollar, but how knowable is that dollar amount? It could be a range of figures.
Yeah, it could be. And that's why these plannings, it's never a yes or a no. It's a range of potential outcome. And most of it is due to the volatility of the markets. We don't know what path the market is going to give us over the next 10, 20, 30 years. We just know maybe a range of possible outcome that says, okay, we are good a certain percentage of the time, right? So those little Monte Carlo are quite useful in those scenario analysis, and said, okay, here we have a high chance of success, and here we have a lower chance of success.
Wow. Two things came to mind there. One was, if you just do a straight line calculation of inflation and rates of return and taxes and all of that, you'll get a number on how much you need to have. Like, I need 1.6 million, whatever that number is. But if you run a Monte Carlo simulation on that, you'll get a number of like 0.5, a 50% chance that you're going to actually achieve your goal, because it might be better or worse than that. So if you get to like a 75%, which is a desirable number that you'd want to have, generally, that's going to consider good times, bad times, all of that. But the other issue that brings up another question I was going to ask you about, guarantees. So some people have lots of guarantees in their portfolio in their situation, like this plan that I just worked on. 3 different guaranteed sources that were already there, 2 pensions and then Social Security. Most people don't have that today. So how are you thinking about how much to recommend to put into guarantee type investments? Because we can guarantee higher numbers by using annuities or other guaranteed type products. What is your way of thinking of when you should use them and how much?
Yeah, there's two for me, there's two ways of looking at this problem. First is a psychology, or how do you feel about risk, right? Some people need that sleep at night factors. I think of my dad in that bucket, needed a high visibility and couldn't deal with market volatility. So there certainly is an aspect that will, for depending on each individual, what is the right amount. I think besides whatever recommendation we may make as far as we think this is the right amount, right? But that, putting that aside, if you look at the numbers, you want to look at your expenses and at your cost of living, for example, and said, okay, how much of that cost of living is fixed expenses, right? The things that I cannot, that are not discretionary, that are not flexible. And maybe you look at that amount and said, okay, is there a way that we can ensure that amount? And said, okay, you will never not cover your fixed expenses for your lifetime. That would be a nice thing to be able to say, right? And maybe that is a good amount to look at. And then for the other stuff, then we can live off our portfolio if we're willing to say, well, sometimes we may be in a position where maybe taking out extra money may not be the right time, and we may be able to make decisions on more discretionary basis on that standpoint, right?
Yeah. So basically, match your guaranteed income sources to match your non-discretionary expenses and your what you have to pay for, food, mortgages or rents, whatever you need. You know these numbers are going to be there, so your basic living expenses are covered no matter what. It's like having a payment or a paycheck replacement. And I was thinking about paycheck replacement because I saw a really interesting article that was actually put out by Great American, which I was really surprised. It's this piece called Simplifying Social Security. And they had one chart that I thought was really interesting. And they did this thing called a replacement ratio. So for the average person, if they put money away in, with a certain amount of salary, the question is what percentage of my salary that I have right now will be replaced by Social Security? That number is like 26% for many of our clients. So basically, I mean, that's the middle level client. So if it's a high income earner, it's going to be much lower. If it's a really low, but you have to be really low income in order for it to replace up to like 58%. Mm-hmm. It's not, I mean, it's a really, if you're lucky, you'll get half of your income replaced if you're lucky, but then you're at a very low income level. So it's a really interesting thing because people, Social Security can be considered a guaranteed source. Hopefully it is. And I like to think that it is for most people. But there was that concept. So let's say we get half or a quarter of our income replaced by Social Security if we're earning like say 130,000, something like that. That's like your best case scenario if you wait to full retirement age. So and if you look at these charts, they have another interesting chart I was going to mention to you. There's this chart where they go, okay, you can take, you have your full retirement age. For most people, full retirement age is age 66 and a half. And if you take money before that, you get less than full retirement benefits. You can take it as early as age 62. If you take it after full retirement age, you get more. So the question is when do I take it? And so they've done some break-even analysis that I thought was really interesting. So I'll just list it out. Just if you collect at age 66 and a half, so if you start early, right? You basically, if you collect at age 62, you have to live to age 78 before you break even to taking it at full retirement age. Right, age 66. So basically, you'd have to live. If you die, before that, or then you have a problem, right? You won't break. I mean, after that, if you die after that, you have a problem. So the longer you live, right? Then the longer you live, the more you want to wait. Is kind of how it works out. So, but we obviously don't know these things, but it's good to kind of know the break-even point. So the age of 78 is the break-even from taking it early at 62 to taking it at full retirement age. So once you live past age 78, you're better off for most people, you're better off taking it at full retirement age. And life expectancies today are, for men, I believe it's 80. Let's see, I wrote it down. For men, it's 84. For women, it's 86 and a half. So for most people, taking at full retirement age makes sense. If you live longer past 82, and a lot of people live past 82, then you really should wait to age 70.
Mm-hmm.
It's very interesting. If you've got like amazing health and you have lots of other sources, maybe you take it. Now that assumes everything stays the same as it is right now. Of course, the government could change anything. But I think we have to start thinking, the closer you are to retirement, we have to start thinking about like, how are we going to actually do this Social Security?
Yeah. And
What are we going to take?
it poses a problem. Again, you go back to asset location. So let's say you do decide to delay taking Social Security for 5 years until above 70, right? Well, you need to survive, let's say, that retirement, that first 5 years of retirement, assuming that you will have other sources of money to pull from. And again, this is where the break even will change depending on the cost of taking that money for that 5 years versus the additional Social Security income that you can get by waiting. So and all of that will, of course, increase. Again, we go back to that percentage of success, right, on the longevity, because there's always there's always these. It's a three-legged stool, right? So it's how long is your money going to last, and how much money can you pull out sustainably, and what what risk are you willing to take to get there? So it's always balancing these three things. Some of it we control, others we don't.
But rarely does it make it sense to take a lot of risk, though, once you get to that point. Unless you have a tremendous amount of wealth that you can live off of, and it doesn't really matter. But you're right. There's that gap between, a lot of times, if you wait till, if you retire at age 65 and you're not going to get it till 66 and a half, then you have a gap, or it could be even longer. If you're forced to retire, we've seen this a lot. People are forced to retire at age 60 and they can't find another job, or it's just, they just decide to retire. Then they have a much longer 6-year gap. And sometimes that's where annuity can help too, if we need to replace that gap, so it just depends on that client's situation, but it's a complicated situation, a complicated equation. It's not as simple. I wish it was simpler, but you have to run the numbers.
Yeah, you have to run the numbers. And I cannot emphasize enough the importance that a small change in someone's situation changes the recommendation or the maybe the course of action, right? So, I mean, you've seen that many times working with. That's why this is not a template. This is not a recipe or formula. You just need to look at everything and see what what is possible to achieve.
Can you give me an example of like what you're seeing, like sensitivity, like what types of things would change that would really have a big impact? A small change would have a big impact.
I think what we see is it depends on the assets, right? For example, if of course we talked about pension and guarantees, which are less and less available. So depending on what is the amount of buffer that you said, like amount of guaranteed income that is available, makes a big difference, right? So the other big one is, let's say you have assets that are, for example, real estate, or that are available later, right? So what is the timing of that, of when the assets are available to be drawn from, has a huge impact on the longevity of a portfolio. So you'd be surprised. I mean, putting aside the your return expectations and the likes, it has to do with the source of those cash flows, right? So you have to fund these cash flows, and you have to you have a number of sources, and then how you deplete those sources, or prioritize those sources, right, is another thing, right? So like you said, should you pull from, hopefully people have taxable flexibility, as you mentioned first, where you have the ability to maximize taxes, optimize taxes, and sometimes it's not an option because every dollar you pull is going to become taxable. And then that is the way it is, right? So
on page 32 of the Financial Freedom Blueprint, there's a little chart, and it's kind of the base case of order of withdrawals. So, do you have to take the money out? Like if you have mandatory distributions, yes or no? If it's a taxable account, do you need more funds than what the taxable accounts can take? If so, you still need more, then you do this. If you have, if you don't, you do this, and then you take tax deferred first, then tax free. That is the template. It doesn't always work that way. That's kind of the base case, but if you have that tax diversification, that adds a huge benefit. So I was thinking about another conversation I had with a client yesterday and day before yesterday. And this client has mostly real estate sources and some tax-free insurance, like a whole life type stuff, or assets, and then also rental real estate, which is really not free cash flowing yet. And you see that a lot. A lot of people have all these rentals, but they're not free cash flowing, and either you're feeding it or you're making a little bit, or maybe you're getting some tax benefit. But a lot of people are not getting as much tax benefit out of them because they've changed the rules, the tax rules. So you're really not getting as much tax benefit as you used to out of rental real estate. So, but now we're saying, okay, she has a different scenario and a 401k. Not a lot of liquid. So that's a different scenario to deal with than client C, call it, that has half of their wealth in they can get to at any time, can do all sorts of things with that. That can kind of, go between it. And another thing I'll mention, and we're kind of running late on time now, but another thing I'll mention is this concept of the reverse mortgage. For some people, another form of assets that they can take from is the equity of their home. And some people should look at that. Usually people who are not in a little bit lower net worth, sometimes in the higher net worth, if most of their net worth is in real estate, but they've actually been cracking down on those rules for the higher net worth people. So there's just so much to think about, JP. I wish we could talk for hours on this stuff. And we should probably dissect a little bit further, but with your investment expertise, I think, I learned a lot from you about how you're thinking about the timing and the taxes and all that stuff. So if you had one piece of advice that you would give somebody who hasn't done a financial plan yet, what would that be? How would you start?
Okay. Think of 3 steps, right? First is always, we will harp on that point over and over again, is identify what your goals are and quantify them. Okay. Laying out, as specific as possible as to what that looks like. Then there is a timing aspect, which, again, will go into the third step, which is then look at the funding of that. Okay. And only when we have those 3 things can we really look at it and provide, okay, this is the best way to fund that particular goal. And I think, it's a simple process, but requires to roll up your sleeve and do some worksheet. And I think the book does provide great guidelines on that. So, and then when
there's we actually updated the goal grading worksheet. Actually, you know what? I will put in the blog a link to, and also on YouTube, a link to the goal grading worksheet, which basically is much more in detail. It helps you prioritize, think about all the things you need, or kind of dimensions of each goal, and then prioritize them. That's really getting to know what you want is hard. It's actually harder sometimes. And also trying to get a dollar amount on it is, but you have to get some dollar amount on it and give it a range, right? Even if you don't know what it is, it's throw a number out there that sounds reasonable, or a range of numbers. So that's really good advice. Get those goals done, and then you gather your data, and there's a whole process. But so, well, thank you for that. But before we go, I want to just, we will put a copy of this Investing for Sustainable Lifetime Income white paper in there. It really goes into detail. If you want to know how this works, the effects of withdrawals, it goes through effects of taxes, how you should think about portfolio volatility. What is a sustainable withdrawal rate? Do I need more of a guaranteed in my portfolio? I'll put that white paper in there. That was actually written in 2008, but it's all applicable. I wrote that back then because this problem was becoming more of an issue starting back then for many clients. And then also I'll include this. This is actually approved for people to see. This is a great piece. This one that says the simplifying Social Security, really good piece, because I think it will just help people get clarity about what to think about. Taking it early, taking it at full or late, and how much of my income salary am I going to actually replace? Because I think it can be daunting. Social Security can be daunting. There's a lot of little rules, and most of the time, in order to get your rule put together, it requires a phone call to the Social Security Administration to get it. Yeah. So, but thank you, JP. Do you have any final comments before we sign off?
Yeah, I don't want to be a downer, but I want to make sure that, we want to help people reach their goals. If we can be help, of course, we'd like to do this, but I just can think of my father. So my father passed away a few years ago, way too early, but he always wanted to go to Italy. That sounds like a simple goal, but basically kept pushing it like, okay, next year. And one time there is no next year, right? So besides the fact that I do believe he left us prematurely, I do believe that some of it was the lack of planning or, the lack of money. And he didn't really plan and said, okay, this is important to me. This is one of my bucket lists. And I'm going to figure out how to go from here to here and make it happen. So, certainly this is not a way to make you feel bad or anything, just to make sure that you do make your bucket list and lay it out, and having that knowledge will give you confidence that you can get there and what needs to be done to achieve those goals.
Carpe diem.
Carpe diem.
Seize the day. That's really good advice. Really, really good advice. I could talk about that one for a while, but all right, JP, thank you very much. And we'll talk to you guys next time. Oh, thanks, wait, one more thing. One more thing. Subscribe, get on our blog list. All right. Bye for now.
Till next time.